without further ado, I would like to introduce the first panel to join me on stage. So, Radhika Gupta from MUFG Bank, David Antoni Jerez from PGGM, Hein Tonnaer from Clifford, Roberto Gonzalez from EBRD, and Wray Thorn from Focus Impact Partners. You guys would like to come up because we're going to tackle the small question first of how do producers get through FID. So we will start with the small question and then go from there. So Wray, seeing as you're the first one on stage, would you like to introduce yourself first?
Sure. Good morning. Thank you, Oscar. My name's Wray Thorn. I'm a partner and founder of a private equity firm called Focus Impact Partners. We started the firm a few years ago with the idea that we could invest in companies that were good companies and that are in part because of the good they're doing for the world. And hopefully by helping those companies grow, we could help them do more good for the world. Hopefully by helping them do more good in the world, we could help them be better companies, have more engaged customers, and win in their markets. And so we could hopefully bring a double bottom line approach to private equity investing. We have been involved in the renewable fuel space and sustainable aviation fuel specifically, as it's an area that fits very well with our mandate, also overlaps with our historical investment experience. And we have a partnership today with a company called XCF Global, which is a SAF producer in the US, about 40 million gallons of production capacity, growing to 150 million gallons or more, and utilizing a HEFA technology. So we're working to bring that company to the public markets by merging with a vehicle that we control. So we're excited to be here, Oscar, and to be able to talk about what's going on in the SAF space. And thanks to you for all that you do in terms of bringing attention to this important industry.
It's far too early in 2 days to be giving thanks. Let's see how they go first. Radhika?
Good morning, everyone. My name is Radhika Gupta. I'm in the project finance team at MUFG Bank. So for those of you that don't know, MUFG is a global leading project finance bank, and I've had the privilege of working there for the last 10 years, advising and structuring energy projects in EMEA. And over the last couple of years, I've been leading the bank's strategy on bioenergy and SAF in particular. As a bank, MUFG is really committed to the energy transition, and it's keen to support transition technologies, in particular SAF. For those of you that don't know, we made an equity investment in LanzaJet recently. I'm really looking forward to discussing SAF with you all today, and I'm keen to explore how financial institutions such as ours can support the scale-up of SAF. So nice to meet you all.
So my name's David Jerez. I work for PGGM. We're a pension fund investor, so we invest for the Dutch healthcare pension fund, which looked after the pensions of 3 million beneficiaries in the healthcare sector. We've been investing in infrastructure for about 20 years, and increasingly our beneficiaries expect us to deliver financial return alongside with sustainability and sustainable impact. And as part of that, we've sort of widened what we can invest into in infrastructure. We've got a new mandate from our client to invest in climate and energy transition solutions. And sustainable fuels is one of the themes we've been targeting for that, a space that we've been watching for the last 3 to 4 years. And we made an investment in a French developer of SAF and e-methanol plants. That's a company called Elise Energy. And through Elise, we're working towards reaching FID in the next 12 to 18 months on our first industrial scale production plant. Happy to be here.
Roberto?
Yeah, so I work for the EBRD, the European Bank for Reconstruction and Development. So the bank has a mandate for energy transition and to invest at least 50% of the annual business volume in green projects. And all the projects that we invest in needs to be aligned with the Paris Agreement. So that means that we invest heavily in the energy transition. And SAF is one of the levers for that in a hard-to-abate sector like aviation. So we are exploring several leads in SAF. So our mandate is covers specific countries that are in Eastern Europe, Central Asia, Northern Africa, Turkey, and now Sub-Saharan Africa that was approved 2 weeks ago.
Good morning, everybody. My name is Hein Tonnaer. I'm a partner within Clifford, a global law firm who is very much focused on the energy transition. So we are part of a global projects group, and within that group we have a green fuel group, which we are part of. What we bring to the table, hopefully today, is live experience on how to go to FID on a HEFA-based SAF project. We're very grateful that we are allowed to assist Sky Energy as of 5 years already. So we're quite into the details, a bit too much, I would say. So I need to be careful not to be disclosing anything confidential, but it was an interesting journey. Other than that, we have advising also the banks on the Pakistan SAF project and early stage mandates in Brazil, Japan, and the US.
So let's start big with the question I think that everyone is consistently thinking about. What are the reasons why projects aren't getting through FID currently? What are the major barriers to reaching that? Mark, Radhika, do you want to start us off?
Sure, why don't I start and then you can supplement. So when I was thinking about this question before the panel, I read an article that said over the last 10 years, there have been 190 companies that have announced their plans to produce SAF. And today, only 10% of them are producing SAF, which means that effectively 90% of those projects are stuck somewhere between making that announcement and actually getting their feet off the ground. Now, we'll go into the various reasons why projects might not be reaching FID, but from where I'm sitting, bankability is one of those reasons, and it's a key area that we should explore. The term bankability gets thrown around a lot, and essentially what we mean by bankability is it's a de-risked profile. It's a profile where lenders have sufficient confidence that their debt's going to be repaid. And I think, most importantly, the term bankable is not prescriptive at all. It's not a checklist. It requires us all to take a holistic view of how risks are allocated and how they're mitigated across the commercial structure. That term bankable is evolving, and lenders recognize that if they want to be part of the energy transition, if they want to be part of SAF, they are going to need to take on more risk. I think that's well-known and well-recognized, and we've seen that when we compare the complex energy projects that we're financing today versus some of the projects we were financing 10, 20 years ago, we are taking on more risk. And I think, an important message to make is when it comes to bankability, lenders are really keen to work with sponsors, with their advisors, with developers. They're keen to bring their structural expertise and creativity to make sure that these deals, they not only get financed, but they're palatable for all stakeholders. There's my bit on bankability.
Well, I just picking up on what Radhika discussed. I like to think about the type of investment, across the stage of a project, from the development of the technology to the building, of the infrastructure to be able to provide the fuel. And I think there's been quite a bit of investment around the development of the technology and the development of capabilities to produce sustainable aviation fuel. Where we have seen a lot less investment is when you take that technology and capability and develop it into an infrastructure scale project. And those could be projects that maybe for a mid-sized HEFA project might be $300 to $350 million to a large, let's say, ESAF project could be several $billion. And those, when you look at that scale of infrastructure investment, one of the key factors to being able to investors analyzing that investment, whether it's debt or equity, is the certainty around revenue and the repeatability of that, of knowing what your revenue profile is going to look like. Also, the repeatability around and certainty around knowing what your cost structure is going to look like. So, feedstock and inputs are relevant as well. But from my perspective, a lot of it comes back to understanding offtake. And if you look at the scale of infrastructure projects in analogous areas, they typically have these long-term agreements around revenue and long-term agreements around supply. And that allows the investment community, whether it's equity or it's debt, to get their heads around and arms around the risk that's involved in a project. Offtake is a big, and I'm sure we'll talk a lot about this over the next 2 days, but offtake is a big component of that certainty.
Just also briefly, because we can spend hours on offtake. Just on the term bankability, it's just the same as it is precedent or it is market. It's a great one to say because you always find one to your advantage in a discussion, but the other one also. So that's why you don't really make progress. But for bankability, there's also a flip side on bankability, that is buildability. So you can't have the cake and eat it. There's no zero-sum game. There's always a risk there. And if it's a new technology, even if the 100% of the project is 90% proven technology, people say it's new technology because of the 10%. I think we should spend 90% of our efforts on the 10% and not on the other 90% which are already there. But building a plant actually is, I'm a lawyer, so I can say it, is not that difficult because I'm not allowed to do it. But if you talk to the people who are actually building those plants, it's really proven technology. There's not a lot of risks there which are new. But somehow if there's a new energy transition flavor to it, people think it's a whole new asset class. That's also, and so my point is also on the buildability, you need to be able to compromise, and that's my other point. The fact is that if you are developing a project, those are not the items you would initially think about. And so you tend to forget about those items and need to renegotiate.
So as a chemical engineer, so yeah, I mean, I agree, I kind of agree with you, but we have seen with other plants, new technology that are scaling up some risk and issues, delays, operability, and then obviously the banks see that as a big risk. I mean, if you are a normal type of, like my bank that is quite risk adverse. So that is, so talking about bankability, yeah, offtake you can address, technology risk, you have it there, feedstock supply. So you have many of those that you need to address. But then what we see also is technology risk, but you add up to the type of developers that we're seeing in our countries of operation. There are people that are not used to run this type of facilities. So then you start to add up all these risks, and then bankability seems farther and farther away.
At risk of dwelling on what seems to be the least important topic in getting a project through FID, what specifically goes into offtake, supply agreements that make them bankable? Because we've mentioned sort of longevity in passing, but what are the specific ingredients that you guys look for that makes something bankable?
I mean, is the customer willing to pay whatever it takes to make that fuel? And ultimately, does the customer have an alternative to achieve that decarbonization? And that's, if they don't, then they should be willing to pay. And obviously, the customer may be an airline, then ultimately, is the airline passenger willing to pay the extra cost through that ticket to decarbonize that activity?
Is this building price into offtake agreements, for example? Is that a sort of a critical aspect?
Like there are some inputs into making SAF that you can't just contract for the long term. So can the customer pay for those?
But the customer doesn't want to pay a blank check. So that's where the...
But the investor also cannot, I mean, we're a sort of equity or debt investors, we're also, to some extent taking a leap of faith, investing in a less mature market and less mature sector that will, no matter how hard we try, still have certain novelty risks, certain technology risks that are not like building something of which there's hundreds of examples out there. So can we take on top of that the risk that we build a plant and then nobody wants to buy the fuel? I mean, I'm not in the business of being part of building a 1 billion production plant of something that in 5 years' time nobody wants to buy the product out of.
But I think that the good thing about SAF is there are regulations in place which drive demand. And I'm a big fan of regulations because I'm a lawyer. Don't ask me the details. But I like demand because that's when people are feeling the urgency because there are penalties. Just also you have to pay twice the delta if you don't comply with the obligations in Europe. So that's a good incentive. I promise not to talk about hydrogen, but I think demand is lacking in that sector. Yeah. So therefore, it's difficult to start investing and spending DevEx without the demand being there by law. So to your question, Oscar, on offtake, actually offtake is a very important document. But before you start on the offtake, you need to know all the other elements as well. For instance, your debt profile. Are you going for a mini-perm or long-term financing? Do you take a refi risk? What is your completion date? Oh, let's try and talk to the EPC folks. How is my procurement strategy? Let's start with a FEED. Then you start the FEED. And then is there still competition as an equity party to actually have competition within your EPC providers? It's what we saw in offshore wind, where we had 2 turbine suppliers. And then they were all in marketing modus up to the moment. They put in the BAVO, best and final offer. And then they were in, and then suddenly the rules of the game change. And there's no plan B. And then you are kind of held hostage. Or, let me say, it's a remote possibility.
I think I agree with you, Hein. I think, in the UK and the EU, the mandates that are in place, they provide helpful demand signals. Now, I'm going to try not to sound too pessimistic as a banker, but I think the offtake story quite often determine the bankability for lenders. And when you do not have a mature SAF market, lenders will need some sort of revenue certainty. A demand signal is helpful and it provides context, but they will need that revenue certainty. They are not in a position to be able to take risk on the SAF market. That is not what they have the expertise to take that risk. So when you look at offtake agreements, well-structured offtake agreements that I'm sure Hein is doing right now, and fixed price or cost pass-through, or where subsidies are coming online, and those subsidies need to be able to provide revenue certainty, but also lenders need to feel that there is an element of revenue, certainty on the policy and the regulation going forward. They need to have that confidence. I think we've talked about bankability, we've talked about offtake quite a lot. There is another element, which is feedstock, and feedstock is a slightly different story. The PF 101 textbook answer is that you want long-term feedstock contracts, but the reality is that for a lot of sectors, deals have been banked and project financed successfully without long-term feedstock contracts. So it is possible. And it would just require careful consideration, careful due diligence. Some of the things that we as lenders will look at is, what is that feedstock market? If there are short-term contracts, what are the renewal rates? Are those feedstock contracts sticky? What is the forecast availability of that feedstock? And that is key, because as more and more projects, SAF projects, come online, how do we demonstrate that the project that we are financing remains competitive for the debt tenor? And these debt tenors, if they're 10, 15, 20 years, we need to be confident that that project is going to be able to secure that feedstock in the long term. And then I guess the last piece on feedstock is, what assumptions are you making on that feedstock price? Does that project still survive in a downside scenario when those feedstock prices increase?
On the price point, the price of feedstock's obviously an important consideration. The price you get as selling the finished SAF is also an important consideration for airlines and for the fuel producer, and also in terms of signalling the revenue security. How closely are you all looking at pricing dynamics, what sort of markets are doing in terms of SAF, final SAF pricing, as well as, feedstock pricing? Is that something that comes into consideration?
Yeah, I think that's an important consideration, looking at current pricing trends. Even more important is how you expect those two things to relate to each other over time. So most of the offtake arrangements that we have seen are in some way tied to jet fuel, and that, I guess that makes, in a way that makes sense. It's a blended product, so a good portion of the price is jet. And it does make sense, I think, from the off-taker's perspective, and that's what their other, what their alternative, cost structure might be based around. Having said that, if you shift to the producer's point of view, the margin on the production, and therefore the return on the capital invested to make the production possible, is not so much a function of what jet is priced at. It has to do much more so with the cost of the feedstock that you're converting into that SBC that then gets blended in with jet and turns into SAF. So thinking of creative ways to tie to more index the end price to the input price would facilitate additional production, and I think financing of additional production in a way that the market isn't working currently. One other thought on that front is that there is opportunity for financial markets, I think, to innovate in this area, because if you look at traditional oil and gas, think about the depth of the markets for the types of ways that you can trade that product, that you can hedge that product. It's tremendous in terms of swaps or forwards or futures, physical, financial, and really none of that exists in sustainable aviation fuel or renewable fuels in general. It exists in a very small way, and it doesn't nearly exist in the feedstock arena. So there's opportunities, I think, for financial markets to innovate that could support the certainty that we're talking about, that could lead to greater project finance.
Is there an argument that you'd need to scale up production in order to facilitate options like that in terms of futures and swaps?
Indeed. I mean,
it's a little chicken and egg situation.
There's definitely a chicken and the egg. I mean, those markets have developed on the back of having meaningfully sized physical markets, but they do need to go hand in hand.
Yeah, coming back to that question, I mean, I think that the price for SAF and used cooking oil right now are linked, because it's all HEFA and it's all using used cooking oil. The issue will come further down the line. I mean, ESAF you have a mandate for that. But for the other options that you need to fulfill the SAF mandate, in which you are going to need to use second generation ethanol or other sources, then it starts to get more complicated, how the link between feedstock price and SAF price will go there. And also the lack of incentives right now to go down those routes that are more expensive, and you don't get any benefit because you don't have any carbon intensity correction to the price of your SAF. And that is something that is lacking there, that you have in other markets. So if you go to the biomethane market, for instance, in Germany, you have the guarantees of origins, and the certificates are linked to the carbon intensity of your product. So you can make more money if you make less emissions. So that makes sense.
The SECL is recently dropped down to the third most popular voted thing from the audience is technology risk. So David, do you just want to take us through how you think about new technology risk and how you sort of consider that, manage that, understand that alongside the myriad of other risks you've got to contend with?
Sure. So for this energy transition mandate that through which we can invest into SAF, our aspiration is to invest mostly in TRL 7. So we use the TRL framework, technological readiness level, and we focus primarily in technologies that have reached at least TRL 7, which, as a non-engineer, as a non-expert, I will describe as it has been built at industrial scale, and you can see it works from start to end, whatever it is the technology you need to use. And I think that's already taking more risk than when we invest in motorways or in wind farms or all of the other things that rely on technologies that are TRL 9 plus, I think people call it, because it's just been hundreds and thousands of times built around the world. So yeah, that's kind of the simple answer. We want to make sure it works from end to end, and we are willing to take that additional risk of something that is still relatively novel and hasn't been operating for many, many years, which also means we have a higher return expectation, let's face it, because we need to be fair to our beneficiaries. We can't just, take more risk with their money without being compensated for it.
David, may I ask you a question? Are you then also a fan of EPC or EPC rep? If you look at, let's not reinvent the wheel. If you look at data centers, offshore wind, you have parties taking equity in the early stages.
Yeah, and absolutely, wherever possible, if there is a possibility to have a wrap for the whole project, we would look for that. And ultimately, we're not the most knowledgeable party about technology risk. There are the licensors out there, there are construction companies out there whose business it is to do this. And, as far as I'm concerned, wherever possible, they should be wrapping it. And of course, they will get paid for it. And if the project sustains the price that it takes to wrap the risk, then the project will get built. Meaning, goes back to the off-taker, if the customer is willing to pay the molecule price that repays that capex, then the project will get built.
I agree. I think as lenders, we're not technology experts. And when we look at a new technology deal, we actually rely quite heavily on the sponsors and the developers. We want to work with people that we know well, and we rely on their sector expertise, their track record in that sector. And actually, we want them to be able to walk us through that technology to help build our understanding. And actually, through that financing, a bit of a hand-holding approach where they can, let's get into the nuts and bolts of that technology. Give us the opportunity to understand the technology as well. So I think I agree with you, but it's probably less prescriptive for us. And we rely heavily on the experts telling us, is there a pilot plant already in operation? How does that translate to the project that we're financing? Tell us how complex is this technology. If it's not that complex, maybe we can get on board. Or are there similarities with other refineries or other established technologies? Explain those differences to us, explain that scalability, and we can help bridge those gaps with the sponsors, with the advisors, to try and make a deal that's bankable, that banks will finance. I think it's important to say that the project finance market have banked numerous new technologies over the years, right? So last year we financed our first carbon capture deals. We can finance new technologies. It is 100% possible. We just need to make sure that these deals are structured well.
Roberto, as a recovering engineer, would you agree?
I mean, the only thing is that with TRL 7, you rule everything out except HEFA. So, and that then we come back to the issue that there has been discussion in other parts about ESAF, what happened to those. And I mean, I think that we are all more or less the same profile as debt providers, pretty standard, boring. But you have venture capitalists there trying to look at that and invest in those. And you have some people like Breakthrough Catalysts, like putting grants on this. You have the Innovation Fund trying to put money on that should do more. There is some ETS money that is going back to SAF to support the ESAF. So there are mechanisms that are trying to bridge that technological risk and get those first reference at commercial scales into place. Then afterwards, then boring lenders will come and finance the next ones.
The trouble is the gap between the two is quite large, between the ability to what a venture capitalist can do. But on that, Ray, how closely would you look at the capital stack of if an ESAF company is looking at developing this new technology, get it through to a TRL 7 level at some point? Would you look at sort of the profile of the existing venture investors, what else they've invested in, their expertise as well, and what they're backing? How much does that come into consideration?
I think that's. I do think that's important. But I think that has to do with a little bit of the team that's around the overall project and the confidence and the ability of the team to execute against the project. And so the backing of the venture firm is typically not going to necessarily be able to bring you to scale, to a scale project because of the dollars involved. Unless it's perhaps an alternative investor like someone like Breakthrough, or that might have other sources of capital that could bring it to scale. I do think the opco topco approach you tend to see often or devco technology company, especially in the scale projects that we're talking about, because it for the traditional institutional investor that TRL7 is important to be able to get comfortable with the risk, the technology risk that they're taking. I mean, I think about it. I mean, you just assume that projects are going to take a little longer and cost a little more than you initially, even ones that work. They end up working very well. You're tending to plan on that being the case. So having a binary outcome, whether that it doesn't work, is not in the realm of risks that you're underwriting as that institutional infrastructure scale investor.
Roberto, as the development bank on the panel, looking at sort of creative ways that you can structure financing, looking at public-private partnerships, things like that, is that something that needs to be explored more in order to sort of get people more tolerant with the levels of risk we're talking about? Because obviously there's no easy way to get to TRL7 for new technologies, and obviously they're going to be a critical aspect coming forward in terms of production pathways. So how can that help sort of push things from 7 down to maybe 6 and get more pathways involved?
Yeah, so I mean, for SAF projects or any actually biofuels projects or energy transition projects, what we're using now is first loss cover guarantees that we have, and that can go up more for more risky projects like SAF projects, and that helps a lot to de-risk the projects. It's not silver bullet, obviously, because if the project will not be bankable because lack of offtake or weak offtake, we will not go for that. But that helps a little bit to put what we were discussing at the beginning. There will be risks, so how to tolerate a little bit more risk, so that we use that. Then for we have other concessional funds that we can use, and then for very specific projects and in a bespoke manner, we can seek grants to support the projects. That is what we use. PPP we haven't seen for SAF projects. I think that we are far from that. We are discussing that in other projects, but not SAF.
Would you be willing to consider PPP if it's a defense angle? Let's talk about security of supply. Then the army is the off-taker.
Yeah. Maybe, but we haven't come across that. I mean, in the countries that we operate, I don't think that the army is willing to pay more for the SAF. Mm-hmm. But what we see is more the collaboration between the airline sector that has a mandate, the airline itself, to offtake SAF rather than the army or something like that, or exports to Europe, to be honest.
In the U.S., the loan guarantee programs have been, I think, have been very helpful. Not making a political statement, but they've been very successful in terms of being able to develop, the SAF-related production, and many of them are structured in a PPP type of way where there's risk sharing. So that the USDA program, for example, 80% of a loan was guaranteed. 20% was non-guaranteed, and so was owned by market-oriented investors that were, and there was a risk differential, interest rate differential for those two pieces, and that coupled along with, equity capital that is taking greater risk has allowed a lot of projects to get completed, and so I think that type of public-private partnership can be very effective in helping projects scale up.
I concur. I think we also advised the Department of Energy in the US on one of those guarantee products. But you see also the likes like Atradius or UKF or IFO, AKF, for the old-fashioned people, promoting the product. And they are quite helpful also in finance documentation processes, which are very, very cumbersome. So okay, I would support that.
Is that an aspect that slows down FID discussions, the amount of paperwork that you've got to read and go through?
It's a lawyer's paradise. Now, the whole thing is, I had a 3-year break being a lawyer, did a renewable energy company where went bankrupt, so it's a steep learning curve. And I have a lot of respect for developers because I know the risk they take, and then the bank tells them, "Oh, you get an upside when you close," but they forget people take 10 years of risk, putting everything in the mortgage, the family. So having said that, so then you start the process. Let's go for a bank launch. Let's start to attract debt financing, and then the first question you get from a banker is, "So tomorrow you go bankrupt. What happens?" That's not a very good start.
They call you.
But that's quite annoying. And so you think you are there, but actually it's the start of a whole new process. And so A, you need to be very fit. And B, have credible advisors. And C, think about elements. And so we developed a set of golden and silver rules to help developers without more expensive lawyers, don't quote me, doing their thing, because it's all about dev expenditure and keep a little debt. So if you, for instance, on the licensing, ARA, TOPSO, don't forget to have the confidentiality broadened to also have lenders and advisors look at that document. Because if you need to go back, it will cost you another item in the documentation. And if you think you have a term sheet, again, there's a lot of similarities with other industries. So you're almost there on the big contract, but then what's missing is the cap and liability and the contract price. So that's quite difficult. So indeed, Oscar, documentation is a very tough process. The key items we came across are, of course, liability, the cost plus structure if you have them, but change in law risk, which is quite annoying. So you can't have that sit entirely with the project because then it's a lender risk. But then ask an off-taker or another party to take that risk in full without knowing exactly how the regulations will evolve is also not a very fair solution. So we probably end up, hopefully, in sharing it or pinpointing to what elements a change in law may trigger, and then you come to an expert determination, etc. But it's not a good start in early negotiations when you're a bit in marketing modus to ask questions like, okay, if you terminate my offtake contract, are you repaying the entire debt and hedge break cost? People go berserk. They don't like it. But it's actually one of the crucial elements banks will probably look at, or at least will ask advisors to have that checked. So if you add it up, and then that's just on the structuring, and then on and on and on. But it's licensing, termination payments, change in law, those type of elements which take a lot of time to progress.
Do producers necessarily know when they're looking at these, do they know what they're walking into, or are they kind of blindsided by the amount of questions you're asking them?
Well, you have to give it to them. And asking an airline for a 15-year offtake contract when they're used to doing spot price, I mean, it's a whole different mindset. So that's why I think people can learn from others or advisors or people with experience. And again, I have a lot of respect for airlines who are doing that because they're absolutely not in their comfort zone because they're not used to long-term contracts. So yeah, I fully agree.
I think I'm going to have to respond because you called banks annoying a few times there, so I need to defend myself.
I was hoping you didn't notice.
We'll blame developers next time.
We definitely can be annoying, but I think the explanation to that is you've got to, like, where banks come from is they typically have a lower cost of capital. So our focus when we look at these deals is capital preservation. We need to ensure that for every deal that we finance, our debt gets repaid. So our only focus on these deals is those downside scenarios. Those doomsday scenarios, we need to be able to evidence that in all reasonable downside cases, our debt's repaid. That is how money gets out the door. So I completely agree with you on all of these deals. We do appear to be pessimistic, and glass half full, but that is just because we focus on capital preservation. Upside gains are great, but we place no value to upside gains. They're rightly captured by equity. Equity absorb more risk for more reward, and that's the right risk allocation, right? So we have a lower cost of capital, and so that's why we can appear to be quite annoying all the time.
But again, take it as a compliment, because if you have it financed, it's really scrutinized. So you have a good deal. So
Hein, are debt people or equity people more annoying?
I think let's equal.
Equal.
But from an equity point of view, you can look at other elements like Plan B. Can you turn into biodiesel if feedstock is running out? Or what happens to byproducts? Don't forget the value of naphtha, propane. So I agree, Radhika. Definitely, it's very healthy to look at downside, because a project always is a project. So something goes wrong, and be prepared. I'm very much a fan of that. And equity is probably looking more on the upside in the P50 scenario for all these other products. And banks, and rightly so, focus on the base case and the sensitivities.
Ray, would you agree?
Yeah, well, I was actually going to maybe pick up on a slightly different point in that, and I was looking at policy being kind of the number two, reason why projects are not reaching FID. And I was going to say that this is from the U.S. perspective. It does appear that policy in Europe in particular is starting to work. It may not work as fast as as industry or politicians might want it to work, but I think you are seeing more industry participants that are subject to policy and mandates, looking at in depth around how they address those potential considerations 4 or 5 years from now, and thinking about specifically taking on offtake related investments and longer term commitments to ensure that the production capacity does end up coming to fruition. So I think policy being consistent, especially these are projects that take multiple years to build, and then will have their returns be over many years. So policy consistency is super important. But I do think you're starting to see more signs of it working to the desired outcome.
And I think that there is a lot of pressure on the EU to be consistent and not change, actually.
Right,
and they have come across every day saying we're not going to change.
Yes.
So I think that is a good signal. Yeah.
Now in the U.S. we have volatility in our policy, so
A little
we got the opposite.
At least it looks like you're getting some now, so that's encouraging.
Yes, but even on from the U.S. perspective, with the budget bill, that's the subsidies for for sustainable aviation fuel and renewable fuels do seem to not only be preserved, but actually, at least in the current version, extended, which I think is going to be quite meaningful for production capacity in the U.S.
We're going to have a debate later today about whether carrots or sticks are better policy structures. So we'll get people arguing over which one works best later. But we'll jump to some audience questions. We'll take the one at the top. Do you guys think that the current commercial structures are placing risk in the right place, in the right part of the value chain? Does anyone have any thoughts on that one?
I could jump in. I don't think the current commercial structures facilitate the development of meaningful infrastructure scale projects. I think we've talked a lot about that on the panel. That and it's not. I don't think not to assign blame to anyone. The folks that are purchasing fuel, airlines, aviation industry participants are do not have a long-term production. They don't have long-term commitments on the other side. They're selling their product on a spot basis for the most part. So it's not from the kind of the end customer, whether it's the consumer or the business or the airline, down, there isn't a long-term commercial structure that fits the type of infrastructure scale investment that needs to happen. So either it has to come together because of policy, which I think you're seeing in the U.S., or maybe it needs to be supported, by government, action, as you're seeing in more in the U.S. or perhaps supplemented by loan guarantees or otherwise, but public-private partnerships. But something has the commercial structure that exists today doesn't really fit the building of hundreds of millions of dollars in 20-year projects.
I like how you put not to assign blame and then firmly laid blame. So well hedged on that front. So
I guess I'm the only one who took that question on.
True, and well, I'm thankful for that. What about the lack of engagement from obligated suppliers during the initial stages of projects? Do you think, if we're talking about obligated suppliers in Europe, they're the fuelers, do you think they could get involved in the conversation sooner? Are you sort of interested as to know why they're not engaged in the conversation as early as you are, or have you not really? It's not really something you've really thought about or is of concern?
So my experience, from the projects that we have that are targeting Europe, they are involved very, very early in the conversation. So they're very tough, though. They have the upper hand, or they believe so. But yeah, they are involved from the beginning.
Same for me. So that's a very positive sign. But what I, again, also looking at other industries, I think it would be helpful to spend time together in a room to discuss the dynamics of these type of transactions, because again, that's a whole different animal. And in a project financing or an equity setting, 9 out of 10 is not good enough. 10 out of 10. So everybody needs to win, but also everybody needs to give.
Mm-hmm.
That's what I like about projects. So you need to juggle around in various interests. So if 1 or 2 parties are blocking that because they still are, or perceive or assume they are the ones who are calling the shots, I think if they would give in a bit more on bankability requirements, for instance, or be a bit more lenient on LDs and performance, it would really push the industry and those negotiations quite quickly forward.
I think it also brings up an interesting point about which we haven't talked about yet, about the infrastructure requirements to be able to get the fuel from the producer onto the wing of an airplane, because that's ultimately what we're trying to do, is to burn a lower carbon intensity fuel. And there's a lot of in traditional oil and gas you might call it basis differential, but there's a lot of difference between what the fuel is selling for where it's produced and what the fuel is selling for where it's consumed. And so that control of that infrastructure and to get from production to consumption is also a pretty important value part of the value chain, in overall adoption of sustainable aviation fuel. And there's opportunity, I think, to both make money as well as to understand how that can impact the profitability of production.
Someone's asked a question about the UK introducing the revenue certainty mechanism and that sort of policy. Do you think policies like that will result in us seeing more get through FIDs? And if not, what do you think is missing from the equation, if you sort of add that in as well?
So I can start. I think the revenue certainty mechanism and the guaranteed strike price mechanism will certainly unlock investment. And we've seen that firsthand, right? We've seen that with the CFD and offshore wind. It will provide lenders with that revenue certainty. I think the risk areas are just having certainty on regulation, on policy, understanding when that regulation is going to come in, who's it's going to apply to, whether your project's going to be eligible. And actually, between now and when all of those questions are answered, it's going to be very difficult to get these projects off the ground until lenders have all of those questions answered.
I would say any mechanism that tries to give revenue certainty, I think, at least from my side, it's going to have to be scrutinized on where's the money coming from ultimately, right? And is it coming from the polluter? From the activity that needs to be decarbonized, and a revenue certainty mechanism that's expected to be funded out of general taxation doesn't have much credibility. But a revenue certainty mechanism that is funded out of, for example, carbon pricing revenues from the same industry that we're trying to decarbonize, and with clear certainty on that carbon pricing, on how long it's going to stay in place, at which price. That is a much more coherent story that we can get behind, which ultimately means, is the customer willing to pay?
Right.
And will the customer be made to pay in this case? Because aviation, let's face it, has nowhere else to go if it wants to decarbonize in the coming 10 to 20 years.
And also, how sustainable for the long term is such an incentive? I think those are very welcome. But if that's your base case, again, what happens? And we've seen that. And it also can block certain development. If you look at, for instance, offshore wind now, where there's talk about CFD, but there's also parties around there who are developing without subsidy or CFD. Yeah, any offtake party is probably waiting and trying to have a better price. So those projects which are actually ahead of the curve in developing are now being suspended or delayed because of very well-intended new incentive.
I think 28% of the audience are either lawyers or investors. Has anyone got any questions from the floor? Old-fashioned with a microphone? Or is everyone happy? We have got one from the audience. There is a microphone coming your way swiftly. So it's coming now. This is your way to jump the queue if you put one on Slido and you don't think we're going to get asked, by the way. So.
Yeah, thank you. I'm David. I'm from Shafar Group, China. We are refiners of UCO and also SAF. So my question is, we're seeing major oil companies investing in feedstock supply chains in Asia, especially in China, and to secure long-term SAF production. Yet many Western financiers seems to be hesitant in doing so. So I want to know what's really going on with that, and how this can be tackled. Thank you.
Anyone want to jump on investing in China?
I can give a bit our perspective. For us, investing in SAF is done out of a mandate that's already taking more risk for our participants. So we're sort of looking at a higher risk and return mix than what we normally would be willing to. And as a result, we're looking to do that closer to home, at least at the start, because, honestly, these are risky ventures, and we want to be able to be close to management, close to the project, and which also rules out at least directly doing the US for now, but that's just at least our reality.
Sure. So I think so I'm from MUFG, and MUFG is a global bank, so we cover all parts of the world and invest in project finance across the globe. I wouldn't say that our decision to invest in projects is not dependent on the pathway, the technology, or the location or the jurisdiction. It is whether we can find the right project to invest in. And it is essentially what we've been discussing for the last hour, half an hour, about these projects being bankable. And one element that I guess we haven't discussed is we also have relationships with sponsors and developers. We want to build on those relationships, and we want to support those sponsors that we know well. And we want to stand behind sponsors that have the right sector expertise, that know what they're doing. And so when you put all of these things together, we will invest in any project in any jurisdiction with any pathway, as long as it's the right project with the right bankable features.
David, there's one on Slido that I'm going to direct at you in terms of return expectations for impact investors and pension funds. And what's the timeline you're looking at on completion? So it's a nice, easy question for you to answer there.
Mm-hmm. I'll give you a general. It is, at least for us in the energy transition space, we're looking at returns that are in between what we would expect in private equity and what we would expect in traditional infrastructure.
Nice and specific.
You can fill up the two, but that's obviously a wide range, and also the timelines we're looking at are longer than your traditional private equity investors, but also shorter than what we traditionally look at as an infrastructure investor, which, you know, traditionally we would look at sort of 15, 20 plus, forever timelines. We're a young pension fund, 3 million participants, most of which are not retired yet.
Have we got any more questions from in the room? There's one right at the front. Hang on, acrobatics.
I'm honoured. I'm Peter Vardigan, Swiss Capital. I just wonder if the panel feel the OEMs have got a role to play here, the Airbus, Boeing, Rolls, etc.
Well, I mean, we've seen, I think some of the OEMs are getting involved in some small amount of purchasing of SAF. I think that probably it's a role, it's a signal. But I mean, apart from further than that, I wouldn't say, at least for us, like, of course, anyone that can chip in is welcome, but it is really the role of the OEMs to deploy capital or to buy SAF for the industry. I'm not sure necessarily.
I mean, Airbus have invested in the US, I know, and Boeing have done early stage stuff here in the UK with Firefly and stuff like that. So they are looking at it, aren't they?
Yeah,
but it's just the level that they're prepared or able to go into is the question.
Yeah. And SAF basically is the same technology that they have currently. So it's not that they are trying to develop new, like, hydrogen planes or whatever. So they are trying to put some seeds to get the SAF rolling and keep their market open, but it's not like major investors.
They could buy SAF and for their for the fuel that they burn. I think that would be that could be one way.
Is that as good as investing in projects, buying and off-taking SAF, or are they just fulfilling different roles and they should arguably be doing both?
I think you might see them be able to invest in a venture scale, so smaller dollars to develop new advanced technologies. Not necessarily, but I wouldn't necessarily, if I were a shareholder of theirs, think that their balance sheet should be used for infrastructure scale investments in the space. But offtake relationships perhaps, could be valuable.
We've got another question on Slido, looking at concern banks have for the risk of subsidies SAF undermining projects, given the length of time it takes to get trade remedies in place. Any thoughts on?
I think that
on subsidies SAF?
I mean, if we talk about Europe and the mandates, I mean, the big risk here is when the mandates come up quite a bit. I mean, right now, 2% is nothing, but when they go up a lot, so that will have a cost implication. So maybe some airlines will divert and will, stop somewhere in the middle. And then for the long haul trips, they will move their hubs from Europe. And that is the risk. But for that, for instance, Europe has shown the way. Took a long time, but with a CBAM or similar mechanism that they could put in place to protect the European aviation sector. And that is the only risk that I really see on the mandate side in Europe. So it's the market size more than the price.
It's a plus, but also a risk. Europe is Europe. It's just part of the world. And aviation is by nature very international. So I think that's what kind of the different regulations. It's a La La Land scenario to get those all aligned, to be very honest. And also we need to have consistency, so don't change every year. Although we would like to have the 5-year window be more gradual, but so I think that's where the tricky bits come in. I think we all do our best, but then there's so much initiatives that it's difficult to keep track. And how do we consolidate and focus on just 2 or 3 points?
I'd agree with that wholeheartedly. I think the main risk is having policy certainty. And when you look at these project finance transactions, a lot of the debt that's being requested is for 10, 15, 20 years. How do you provide lenders with the confidence that your project is going to be aligned to policy incentives for that term? Because if you're not able to provide lenders with that confidence, how are lenders supposed to lend you that money. And I think going back to one of the points that I said earlier, I mean, the UK and the EU SAF mandates are positive and they're helpful, but they don't answer the questions around revenue certainty. Lenders will focus on how specific projects are structured and how the risk is mitigated in a specific project.
And there's an element of complexity, simplicity. The more complex the revenue stream is, the harder it's going to be to finance. But in the U.S., with all the subsidies, it might be a little bit, and that's the experience I'm more familiar with. But there's the federal, there's the IRA subsidy, there's the state level subsidies, there's renewable fuel credits. So what you actually, when you're trying to explain the revenue stream from a gallon of SAF or SBC that you've sold, it actually has half a dozen components that increased complexity makes it more challenging to finance for sure. Each component could all of especially the ones that are subject to policy change get are ones that you have questions raised about them.
One word answer, which one is the bigger risk for financing, feedstock or offtake?
Offtake.
Offtake.
Roberto's not so convinced.
Yeah, I mean, both. I mean,
Both.
if you don't have the feedstock, you cannot have an offtake. So, yeah.
Fair point.
Have we got any more from the floor? Any more questions not on Slido? Before I go take a couple more Slido ones, because I know we're running close on time now.
Just coming back to the feedstock. I mean, competition for used cooking oil is gonna just increase. I mean, the question about China, for instance, China is gonna start or is producing already SAF, so UCO coming from Asia will go to Asia. And so what we are doing in our projects is we need to have local UCO supply, and that helps because some of the countries where we operate are densely populated, and then there is a lot of UCO that can be collected sustainably and be diverted to SAF. But that is something that we're looking at. I mean, we need to have local UCO supply for a big share of the UCO feedstock of the facility.
What about your thoughts on oil and gas and their role in sort of co-processing and developing supply? Is that something
for us? Co-processing and in a refinery, all this is a challenging investment because when we analyze an investment and we need to go through the Paris Agreement alignment, then we need to look at the carbon locked-in and the carbon transition risk. So if we're putting money for a 10-year project in a refinery, there is a big carbon transition risk there for us.
We got so many questions coming in now. I'm not sure we're going to be able to get through all of them. Lots on China and struggling. What about, Hein, what about clauses in offtake agreements that could jeopardize financing? What are the things that that are red flags for you?
Is the glass half full or half empty?
Full?
Let's take a shot. Unclarity about termination provisions. So there's no one size fits all, but it's also not one termination clause. There are various causes for termination and various regimes. And to spell those out exactly and clear, not just by the team who are negotiated those for a year, but also by new people and new advisors. I think that is one of the challenging. If it's a long-term offtake which is used to produce and to construct the plant, I mean, the level of involvement of that off-taker on the production process and the capex spent. Unclarity on the structure. So is it take or pay, send or pay, tolling? But the take or pay sounds easy, but what happens if you can't take? What happens if it's off-spec? It's still jet fuel, or in what I understand, sometimes you can recycle that and then use it again as an input to get certified stuff. So those are, of course, the nomination and testing procedures are for banks, of course, relevant in equity, but for the offtake, extremely relevant. So the Dutch double counting certificates, other certificates, POS, the whole chain of command and delivery of those sets of documents. delivery point. So where's the risk being transferred? Always a nice one. It comes back actually to the story I generally tell. We just align instructions, not when you start a deal, but also in between deals. Because I see advisors, I'm guilty as well, take a stance on positions which you think are the ones your client want to have. But actually, it's good to kind of take stock on where you're going, because advisors can fight battles without clients knowing. And that can also happen in an off-take agreement. Again, in theory, of course.
To what extent are you basing contracts off other industries? So, for example, oil and gas, petchem, off-take agreements, because they cover a lot of these concepts that you describe.
Indeed, so it's EFED as well we use, if you look at corporate PPAs. So it's a mix and match indeed. And that is why it is useful to have a team with various backgrounds. And if you look at a law firm or a bank, a team which covers multiple techniques and energy transition techniques. Because if you do a financing, are you in the real estate team, leverage finance team, project finance team? You think it's the same institution, but they all have a different language. The same in what type of contract do you use, what is market. So it's a mix of match of those conflicts indeed.
I think we've gone over time rather than just run out of time, but obviously it's a big discussion point and one that will continue over the next 2 days. These guys are going to be around as well, so if you've got questions or we didn't get around to your question, I apologise, but these guys will be around if you want to go and ask them in a coffee break. So thank you very much, panel, for that conversation.